Are you maxing out your refund? All right, y'all, it's tax season, so you already know what that means. So if you're already operating an assisted living facility and you're not maximizing your tax write-offs, there's a really good chance that you're probably overpaying the IRS by thousands of dollars. And I'm not even exaggerating. Hi, my name is Deandra. I have nearly a decade of experience in this specific industry, and here's one of the few things that I've learned. Most ALF administrators or owners don't even realize what they're allowed to deduct. So they just write a check and keep it moving. Today, we're gonna fix that. Here are the top 6 tax write-offs ALF administrators or owners should be using before tax season. So let's start with the big boys. Number 1, property depreciation. So let's say Mary owns a 6-bed ALF, right? She bought the house for $600,000. Even though Mary pays the mortgage every month, the IRS also lets her spread the value of the building over time and deduct part of it every year. So even if Mary's ALF makes money in real life, on paper, she might show less taxable income and sometimes even a loss. That's called depreciation. Now, this is where it gets interesting. If Mary does something called a cost segregation study, all right, let's break that down right quick. A cost segregation study is a tax strategy that real estate owners use to save money by accelerating depreciation. Instead of writing off a building over 30 years, it breaks out parts of the property that can be depreciated in 5, 7, or probably 15 years. So Mary may be able to write off parts of the building faster, especially in the earlier years of the business. So number 2, staff payroll. Now let's talk about your people. Caregivers, nurses, administrators. Let's talk about them. If Mary runs the 6-bed ALF and pays $3,000 in wages, let's say $500 in payroll taxes, $300 in workers' comp, that entire amount is deductible. Payroll is usually one of the largest expense in ALFs, and it's also one of the cleanest deductions. And if you pay your staff legally, you should be deducting it. Hello? Hello? Number 3, food and resident supplies. If your residents eat with it, your staff clean with it, or you need it for care, it's more than likely deductible. So if Mary goes and buys groceries for the week, cleaning supplies, gloves, wipes, or basic medical items, those are usually business expenses. So if it's necessary to care for residents, it counts. Number 4, repairs and maintenance. So let's say your AC breaks in July. You don't just upgrade the whole system, you just fix it. So that repair is usually deductible right away. Same with plumbing, painting, landscaping, and just safety repairs. Now, if you do a major repair like taking off your entire roof, that's completely different. No. But the normal repairs to keep the facility running, those usually count. Number 5, software and admin tools. Now, let's talk about the boring stuff, but also the necessary stuff, which are the scheduling softwares, the payroll softwares, the residence record-keeping softwares, and the list goes on. So let's say Mary pays $150 a month to have softwares operate her ALF. That's usually deductible. So if it helps you operate your system, it usually counts. Number 6, retirement contributions. This one is the sneaky one. This is the one that surprises a lot of owners and administrators. So if Mary contributes to a retirement plan like a SEP IRA or a solo 401k, she can reduce her taxable income, save for retirement, and build long-term wealth, all at the same time. Isn't that amazing? This is one of the most underused strategies in the ALF industry. All right, y'all. I gave y'all the top 6, but none of these deductions don't even matter if you don't have itemized transactions, receipts, and clear records that these transactions are true. If everything is labeled miscellaneous expenses, you're making life harder than it needs to be. You know I'm a girl for equations. So good receipts equals less stress plus more deductions. ALFs can be a high cash flow business, but without understanding tax strategy, you could lose a big portion of your profits unnecessarily. So okay, y'all, please remember that my advice is purely educational and not tax advice. So always talk with a CPA or qualified financial advisor or financial professional who understands ALFs to make sure that everything is set up and documented correctly. If this helped you, give it a like, subscribe, and send it to another ALF owner or administrator who needs this conversation. Who knows, they might give you $5. And if they do, double it and send it to me. All right, y'all. See you in the next one.